So today I'm going to be talking about an annuity, what it is, basically explaining how it works, and whether it is or isn't an adequate investment for you at this point in time. The annuity is also an insurance product, meaning that it's also offered by insurance companies, and it's sold by insurance agents that have the insurance license and many times have the Series 6 license to be able to sell variable annuities. So the annuity is an insurance product. Many people confuse it with an investment. It's not quite an investment. It's not a security. In the annuity, you're basically making the opposite bet that you are making in the life insurance. So life insurance many times is for you whenever you're in the accumulation stage, which means that you've worked for within your working years and you're accumulating wealth, you're accumulating assets. So if you die early and you haven't accumulated enough to provide for your family, then the life insurance kicks in and covers that, right? So the annuity is usually for people after the accumulation state, after you've been working and you got to a point where you've accumulated some assets, but you have the fear that you may outlive what you have accumulated. So you make the opposite bet. You're basically saying, I'm going to live longer and I'm going to give you some money, insurance company, a certain amount. I'm making the bet that I will live longer than what that lump sum was going to last me. And the insurance company is effectively making the opposite bet, saying you will die earlier than what we think. Therefore, we will profit off of taking your lump sum. Let's say you've accumulated, I don't know, 500 grand. If you accumulated 500 grand and you consume 50 grand a year to live, if you do the math, you only have 10 years. So let's say you're 75 years old and you say, hey, these 500 grand are only gonna last me for 10 years. What do I do? So the insurance company comes along and says, nothing to fear, we'll give you an annuity. Give us the 500 grand and we will pay you a monthly payment for the rest of your life. So that means that if you live to your 110, you will still have some income, right? And of course, they have calculators to calculate how much they can afford to pay you every month, right? So it might only be $1,000, it might be 500, it might be more or less. But the point is that you as a consumer say, okay, well, the worst case scenario, I will always have $1,000. I will always have, $500 or $2,000 for the rest of my life, no matter what. No matter if the market is up, if the market is down, I will always have that money. And so once again, it's not an investment, right? Because it doesn't go up, it doesn't go down. It's an insurance, basically meaning it's insuring your lifestyle to a certain degree, but it's always a bet, meaning that one side will win, one side will lose in per se. So in this case, you knew that if you that those 500 grand were only going to last you for 10 years. So if they were only going to last you for 10 years, then if you lived past age 85, then that's great. The annuity works out and you came up on top per se. You won. But if you die, let's say at age 80, if you die at age 80, well, you would have only consumed 250 grand of the 500 that you had accumulated, and your family would have been left with the remainder amounts. Therefore, you lost, and the annuity company won. The insurance company won. If you live to be 100, then you win. The annuity company, in a way, loses, right? That's essentially the basics of an annuity and why they came about, and how you should see it. Now, the annuities have evolved throughout time. They've evolved. Now they have the variable annuity. They have annuities that will pay you for your whole lifetime. They have annuities that will pay you for your lifetime and your spouse's lifetime. They have annuities that will only pay you for a certain period of time. There's a lot of different annuities, right? So you always got to make sure which one you're getting, and make sure that you understand it and that you understand the differences between them. But essentially, that's the basics of it. That's why they came about, and that's what they do for you. So the annuity has evolved to what's called fixed annuities for the most part, which basically they give you a fixed rate. That's why they're called fixed annuities. They give you a fixed rate, usually about 2 to 3% for 5 or 7 years, and that's it, which is similar to how a CD traditionally used to work. So many people that are age 70, 75, 65 use annuities, not necessarily for the lifetime payments, but just for a temporary investment that's going to generate a 2 to 3% return. And they'll be happy with that. So just be careful and make sure that you understand what you're getting when you sign up for an annuity and how they work. Now, I must say, these annuities were created originally for post-accumulation stage, which means after you have accumulated assets. So what does this mean? This means that it usually is not a good option for people that are during the accumulation stage, which means before retirement. And there's certain industries that get targeted a lot by insurance companies to sell them annuities, and unfortunately, one industry that's that's targeted a lot by insurance companies and that is sold a lot of annuities is the teachers. My older sister, my older brother, my wife, they're all in the education field, and I've started to notice that they actually are targeted a lot by insurance companies, and they're being sold investments such as the indexed annuity as a retirement product. So what happens then? You have to realize what it is that they're selling you. They're selling you an annuity. Therefore, it's not going to grow at a rate of return that's really adequate for your age. I was very loosely reviewing my older sister's investment product that she was sold, and she was sold an annuity, and I realized that it was only making like about 2 or 3%, and I said, man, that is horrible for a 30-year-old. For somebody that's 30, they should not be making 2 or 3% rate of return. But the thing is that they're an insurance product, meaning that they are not governed by the same laws that financial advisors are governed by. Why? Because they're not an investment. You don't have to be a fiduciary. You don't have to do what's best for the client. You don't have to do what's called suitability, which give a client an investment that is suitable for them. No, none of those things apply to insurance products because they're not investments. Therefore, they're not governed the same way that investments are. So therefore, somebody can put somebody in a bad product at a bad rate of return that is not suitable for their age, which is what happened to my sister. My wife, somebody came to her classroom, a financial planner, and told her that to get into an annuity, and an index annuity. Granted, the index annuity tracks an index, and it is more of a security product, and that part is governed by securities. But either way, it's not an adequate product for my wife and at the age that she's at. And granted, many times annuities have a higher commissions upfront than other investment products, because they really just try to sell you the investment. They try to sell you the financial product as an investment, and they basically leave. There is no ongoing financial advice. There is no relationship building. It's just, I sell you this one product one time, I make my commission, and I leave. Why? Because there's no suitability and there's no fiduciary, meaning that I don't have to create a relationship with you. I don't have to do what's best for you. So to conclude, annuities can be beneficial to some people. Many times people that are in retirement or that are post accumulation stage. Many times not for anybody that's working, not for anybody that's within their working years. So just be careful, guys. If you have any questions, you always know that you can reach out. And thanks for listening, and I'll see you next time.